Clients have opened motor vehicle repair shops, and the taxability of sales is a frequently asked question. Let's take a look at common situations where sales tax and exemptions to sales tax apply. The CDTFA, which is the agency that collects this tax in California, have various publications that can provide guidance to specific industries that you may operate in. This short presentation will be focused on repair shops, but there are many publications out there. For example, restaurants may find publications 22, 115, and 281 useful in administering sales tax in their businesses. This podcast is focused on repair shops in California, but we will provide a few examples of sales tax situations in other states where clients may be domiciled. Also, the principles of sales taxation can be applied to other industries, but of course, situations will vary. If you have questions regarding your particular business, my contact information will be at the end of this podcast. So in California, sales tax applies to sales of tangible property. Services are not taxed here, but in some states, for example New Jersey, certain service sales are taxed, such as labor charged in auto repair services. Labor charged for creating or putting a product together is taxable in California, and there are exclusions for the following. So no sales tax on repair labor, or purchases made with a resale certificate, or sales made to U.S. government and in interstate commerce. As mentioned previously, the exclusions or exemptions to sales tax apply to labor and services charged to repairs, unless you are fabricating a product. If your customer provides you a resale certificate, then those sales to your customer will also be exempt. Sales of parts will be taxable unless the sale is made out of state. This is an example of a sale in interstate commerce. That is, the repair shop delivers the product or repaired item out of state for the customer. This rule is specific to California. So what happens when your customer operates in interstate commerce? For example, a long-haul freight transportation company. California does not allow any exemptions unless the repair shop themselves is delivering the repaired item to an out-of-state location. This could be different in other states, such as Washington, where there is a specific sales tax exemption on repair parts used in the repair of trucks and trailers, as long as the carrier provides certain documents, such as their operating authority. The operating authority provides proof that the carrier is engaged in interstate commerce. So sales tax is charged where the sale takes place. Items consumed during the repair service are taxed when purchased by the repair shop. Items such as grease, cleaning solutions, because the repair shop is going to consume them while providing services. The repair shop will pay tax on these items when they purchase them and should not be using a resale certificate to exempt the purchase from tax. Parts are different, as they will be sold to the end user, so a resale certificate should be used on those purchases from the vendor, so no sales tax is charged. Retailers in the business of tangible property must register for a sales tax permit. If you are an out-of-state retailer, you must register in California once your revenue crosses $500,000 in sales or deliveries in this state. This limit includes both taxable and non-taxable sales. So a taxable sale would be, for example, a sale of a product to the end consumer delivered in California. Non-taxable sale could be a delivery of item for resale in California to a wholesaler or retailer. Other states have different Nexus thresholds. For example, Indiana has a $100,000 threshold, which applies to tangible items, products transferred electronically, and certain services provided in the state. Again, Indiana applies this $100,000 threshold to taxable and non-taxable sales, just like California. The sales tax records should be maintained for 5 years. Here's a list of possible items that would help substantiate your sales tax liability. A quick comment on tire fee, as many repair shops, retailers, and motor vehicle dealers are engaged in the sale of new tires. The tire fee is levied on new tires in California sold to the end user. Retailers can keep 1.5% of the fees collected for reimbursement of costs related to collecting these fees from their customers. Thank you for listening today. If you have any questions, please reach out to me. This is AJ from GNS, and I hope to speak to you soon in another entertaining, fun, and easy to understand podcast. Take care.